Hi guys, I'm Santosh and I'm back with another video. So we are going to continue the same option basics class which we have discussed in our last video. Uh, in that video we have talked about options overview and how things work in the options market and also things related to call options, right? And in this video I'm going to focus more on put options and how things work related to put options. So before moving ahead, let me just explain you the types of options. There are basically three types of options. One is in the money, second one is at the money, and third one is out of the money options. So to explain these things better, let me just go to this NSE option chain website. And as we were discussing TCS share example, so I have already opened TCS option chain for 27 January expiry. And these are all the strike prices that are available. And to the left side of the strike price, we have call options, and to the right side of strike price, we have put options. And the region which is in shaded color, it is treated as in the money, and the region which is in plain color, which is white in color, it is treated as out of the money. So I'll discuss in more detail, but before that we'll talk about at the money first, because that is quite easier to understand. When we look at the underlying share price of TCS, it is currently trading at 3,965 rupees 35 paise. Let me write it here. Last traded price of TCS share equal to 3,965 35 rupees 35 paise. And remember, the closest strike price with respect to the underlying share price is treated as at the money strike price. In this case, it is 3,960. If you look at this option chain, you will get to understand. See, we have 3,960 and 3,980, but the closest to one to 3,965 rupees is 3,960. So this is treated as at the money for both call options and put options. What it means, the closer the price to the underlying share price, so which is basically we are playing at the current price itself, right? That's okay. And next thing, so before talking about in the money and out of the money, we need to understand what option premium is comprised of. Option premium consists of two parts. One is intrinsic value and the other is extrinsic value. So the intrinsic value here means the actual value, the real value, whereas the extrinsic value here means the time value for an option contract. Now see, what is actual value, what is time value? Let me take one example. The same strike price, I'll take strike price as 3,960 and option premium for this contract is 68 rupees 50 paise in case of calls. In case of call option, so this is the premium. Now, as I said earlier, premium consists of both actual value and time value. Now, this 68 rupees 50 paise is not just actual value and not just time value. It is a combination of both. Now, so how much is actual value and how much is time value for this option premium? So actual value is the difference between the underlying share price minus the strike price that is selected. In this case, it is 3,965.35 pies minus 3,960, which is basically 5 rupees 35 pies, and this is the actual value, the real value for the option contract. Whereas the extrinsic value is basically the time value. What is time value here? The amount of time that is left for this option contract to expire. So it is 27 January 2022, the expiration for this option contract, and today the date is 15th January, so we have 12 days of time left for this option contract to expire. So this gives us, based on the Greek parameters, this gives us the value which is option premium minus the actual value. In this case, extrinsic value is equal to 68 rupees 50 pies minus 5 rupees 35 pies, which gives us 63 rupees 15 pies. That means for the at the money strike, whatever we have selected, the actual value is 5 rupees 35 pies and time value is 63 rupees 15 pies. But remember, as the days are progressing and as we go closer to the expiration date, this extrinsic value keeps losing its value, and on the expiration date this extrinsic value becomes 0. So what exactly left is the actual value. In case of in the money, the actual value will be higher. The more deep we go in the money, the more actual value it possesses. And in case of out of the money, the actual value is 0, completely 0. Let us take an example and understand. For in the money, let me just take 3,500 strike price, which has premium value of 476 rupees. Let me just write it here. Strike price equal to 3,500 and option premium here is 476. So the actual value we get from here is underlying minus the strike price, which gives us 465.35. So this is the actual value for this strike price, which means the extrinsic value is very less, correct? So 476 minus 465.35, which gives us roughly around 476 minus 465.35, which is 10.65 rupees. Now, if you look at this carefully, for at the money strike that we have selected earlier, actual value is less, whereas extrinsic value is more. In case of in the money, actual value is very high, whereas extrinsic value is very low, which means the real value is very high, the time value is very low. Now we take the example of out of the money. So for out of the money, we will take one example, which is okay, 4,000. How much should I take? Okay, let me take 4,100. Okay, the last traded price is 24 rupees 70 pice. Let me just write it here, 4,100. Strike price is equal to 4,100 and option premium is 24 rupees 70 pice, correct? Then the actual value is 3965.35 minus 4,100, which gives us some negative number, which means that there is no actual value present. Now then that means what? The entire premium is all about extrinsic value. So extrinsic value, when there is no actual value present, which we can treat it as 0. So extrinsic value is 24 rupees 70 minus 0. That means the total option premium is extrinsic value only, and there is no actual value present at all. So from this example, what we understood is, when we go for in the money, we are actually trading on something which has some value on it, but when we are going out of the money, we are trading on something which has no real value on it. Okay, so how does it affect and how it plays, we'll see it in upcoming chapters, but for now these are the things. So the more in the money we play, the more real value it has. The more out of the money we go, there is no value present at all. So it's all about time value that we are trading on. So the higher the risk we take when we go for out of the money options. Okay, so that's about it. If you have any questions related to in the money, at the money and out of the money options, so you can please post the questions in the comment section. I'll happy to help you. And then now we'll come back to our actual chapter, which is put options. So yesterday we were discussing about call options, where there is a buyer for the call option and there is a seller for the call option. In the similar way, in put options as well, there is a buyer and there is a seller, but which is completely opposite to the call options. There the call option buyer will expect the share price, underlying share price, to increase so that he can make some money. But here the put option buyer will expect the underlying share to go some more down so that he can make some money. So that means what? Here the put option buyer is actually the person who is going to deliver the shares at the expiry date, and put option seller is actually the person who is going to take the delivery on the expiry date. Now let us take an example. Let us go with the same example, TCS. So the strike price is we take the same at the money strike price, which is 3,960, and the option premium in case of calls it is 68.50, but we are talking about puts, so we need to take this premium 61 rupees 10 pice. So it is 61 rupees 10 pice. So what's happening here? The put option buyer is making an agreement with the put option seller by paying an option premium of 61 rupees 10 pice per each share to the put option seller, and so that the put option seller will make an obligation that he will definitely buy the shares at the mentioned strike price, no matter how the underlying share price goes. So this is what the agreement is. So as a put option buyer, he is paying the premium and making an agreement. So he has the right to withdraw the option agreement anytime he wants. But as a put option seller, he is getting into an obligation, so he has no right to withdraw the option contract at all. So he has to take the delivery at any cost, no matter where the share price goes. So in this case, let's take different scenarios and understand how the put option buyer will get the benefit and how the put option seller will get the benefit, right? Scenario 1. When TCS share price goes to let's say 3,700, that means in the favor of put option buyer, because here the put option buyer is expecting the share price to go down, and it actually went down. So it went in the favor of put option buyer. Now what put option buyer will do? He will definitely deliver the share to the put option seller. Now what he will do? Put option buyer will deliver the shares at 3,960 strike price to put option seller, and the put option seller has no choice but taking the delivery. So the put option seller will pay 3,960 rupees per each share, even though he is getting at a very cheap price in the cash market. He has to pay 3,960 rupees for the put option buyer and should take the delivery. That's how put option buyer will get the benefit. So he's actually making 260 rupees as profit, but this is not the actual profit because he already made a payment of 61 rupees 10 pice as initial premium amount to the seller. So ideally he was making 198 rupees 9 pice on each share, which means a hell lot of money. So here the put option buyer is getting benefited by selling the TCS share at a higher price than what it is trading in the cash market. So that's how the put option buyer is getting benefited. In scenario 2, when TCS share price goes to, let's say, 4,200, now what happens? The TCS share price went to 4,200, which means it didn't work in the favor of put option buyer. Now, do you think put option buyer will deliver the shares still at 3,960 rupees to the put option seller when there is a chance of selling it at a much higher price in the cash market? No put option buyer will deliver the shares at a lesser price. So what put option buyer will do? He will allow the contract to expire worthless. Now what the put option buyer will do is he won't deliver the TCS shares to put option seller at a lesser price when he can sell it at a much higher price in cash market. So what he'll basically do is put option buyer will allow the contract to expire worthless. That means he will come out of the contract by squaring off his position, and you know what, the put option buyer earlier paid an option premium of 61 rupees 10 pies to the put option seller, so he will lose that 61 rupees 10 pies per each share. That's what his loss is, and the put option seller will keep that premium in his pocket. So this is how put option seller will get the benefit. Now we'll take scenario 3, where the share price remains at the same price. The share price remains at the same price on 27th January, which means the share price is equal to 3965 rupees 35 pies, and the strike price is 3960 rupees. So the trade didn't go well in the favor of put option buyer. The share price is still above the strike price, so he has to lose his entire premium that he has paid, which will be pocketed by the put option seller. That's how put option buyer is going to lose in this case, and put option seller will keep the profit with him. And we'll take another scenario. In scenario 4, the share price goes down, but only slightly. Let's say it went to 3,900 and maybe 40. The share price went down in the favor of put option buyer, but not drastically down, but slightly down. So let's see what will happen in this scenario. The strike price is always the same, which is 3,960 rupees in this case. So the premium paid per each share is equal to how much? How much it is? It is 61 rupees 10 pies. 61 rupees 10 pies in this case. Now, see, the share price came down in the favor of put option buyer. So what benefit the put option buyer gets is he will be able to compensate the loss that he is going to make. In this case, the difference in underlying and the strike price is 3960 minus 3940, which is 20 rupees. So the put option buyer gets 20 rupees, which means total loss for put option buyer would be the premium paid for each share minus the credit received, the profit received. Instead of credit, it would be better saying profit. So how much it is? It is 41 rupees 10 pies. So the total loss for put option buyer is 41 rupees 10 pies per each share in this scenario. So we understood one thing. So in any situation you may take, option buyer can lose up to an extent of the premium he has paid earlier. But whereas for option seller, he can lose to any extent. So two things to keep in mind. For buyers, the loss is limited to the premium paid, but for sellers, the loss is unlimited. And also, for buyers, the profit is unlimited, because if the share price went down drastically, maybe to 2000, then just imagine how much money the put option buyer is going to make. It is hell lot of money. And in the same way, how much profit can the option seller will be able to make? Only up to the extent of the credit he has received in the form of premium. So the two things to keep in mind is for option buyer, loss is limited to the premium paid, whereas profit is unlimited. In case of option seller, loss is unlimited, whereas profit is limited to the premium paid. So please keep these things in mind and choose a better position when you want to trade, because see, for buyers the loss is limited and the profit is unlimited. For seller it is vice versa, loss is unlimited whereas profit is limited. But there are other things to keep in mind before buying an option contract or before selling an option contract. We will discuss in our upcoming chapters. So if there is any question related to today's topic or from our yesterday's discussion, please feel free to put the question in the comment section. And yes, so that's all for today. We'll meet again in the next chapter with an interesting topic. Thank you.